I'm Rick Albert, and welcome to The Key to the City of Angels, the podcast where we unlock the secrets of Los Angeles real estate. With over 300 real estate deals under my belt, I've seen it all, from house hacking strategies that build wealth to helping clients close multi-million-dollar deals in one of the most competitive markets in the world. Every week, I'll bring you expert insights, market trends, and inspiring success stories to help you navigate the LA real estate scene. Whether you're a first-time buyer, an investor, or just curious about what it takes to thrive in the City of Angels, this podcast is your guide to making smarter decisions and achieving your goals. So grab your keys. It's time to unlock your path to prosperity in Los Angeles real estate. Hello, everyone. Rick Albert here with another episode of The Key to the City of Angels. And I am blessed today to have Jeff Chisum of Northpointe Bank, as well as the host of the STR Home Financing Podcast. You're a lender, where we're going to be talking today about short-term rentals, the type of financing that goes into it, and kind of what are investors doing? Because although not everybody is investing in short-term rentals here in Southern California, we have a lot of Californians investing elsewhere. So thank you, Jeff, for being on the show. I really appreciate it.
Yeah, thanks for having me, Rick. Excited to hopefully share something that someone doesn't know, helps them to do
Yeah.
something they didn't have on their horizon to do. So, yeah, thanks.
Yeah. How did you get into it?
I've been originating since 2008,
Good
and
timing.
yeah, exactly. Year of the crash. I'm a survivor. Business has kind of evolved over the years, to a point where since 2018, I've been a top 1% loan originator in the US. So with that, came a place where uh, we were beyond the ends meeting. So we had surplus, we had excess that we wanted to invest finally after the roller coaster in the mortgage business. But so as I was researching, different avenues, I was looking at the stock market, I was looking at, different things, and I'm pretty to real estate where, you know, I can touch it, I can put my hands on it. If it were to burn down, I have an insurance policy to replace it. So looked at long-term rentals, that wasn't real exciting. And plus, I wanted new build at the time, and they wouldn't let investors buy new builds in the area in North Texas that we were looking in. So we had been, staying in short-term rentals for quite a while, or as people like to call them, Airbnbs. Um, but yeah, so we had stayed in those, had experience in those, and of course, you stay in a really cool one, you always get the idea of, gosh, I'd love to own one of these one day. And so, right around 2020, we stayed in a really nice area in north central Arkansas, and found, sort of kind of looking around, that the real estate prices were still fairly reasonable, especially compared to the rest of the United States, where everything was, really taking off. And so prior to that, I had come across some information around the 10% down second home occupancy loan that I really felt was significant. They had made some changes to the policy that really seemed to reflect how these properties were being utilized. So, in other words, they kind of, Fannie Mae knew that people were buying these vacation homes and they were putting them on Airbnb, and they just wanted to make it where it didn't seem like people were operating in a gray area. So, come to this point where we decide to buy a short-term rental. That information came uh, in handy, the 10% down second home occupancy loan. So I won't tell you what interest rate we got at the time, because it's, stupid low. But, being able to put 10% down on an asset like that, yeah, it was a no-brainer for us.
Yeah, I mean, it seems like with real estate investing, especially over the last probably like 10, 15 years, it's really become like, okay, it's super sexy, right? Passive income. And then Airbnbs and short-term rentals came about. And I remember when Airbnb first came out, I'm like, no one's gonna rent out their own house and to a stranger. This is ridiculous. And here I literally just did it last weekend.
Right.
I just stayed at a stranger's house in
Yeah.
San Diego, right?
Yeah. And
So
now people are renting out their own cars. So,
right, Turo. Oh my gosh. I actually joined a Facebook group for Turo because I'm thinking about kind of like on my bucket list to buy one of those like slingshots, the Polaris slingshots. I don't know if you've seen those. It's like
yep,
a
yep.
three-wheeler. But I'm
Hmm.
like, I'm not a toy guy. So it's okay, I'll post it on Turo, rent it out, and that'll offset my toy. And then I'll
Right,
ride when I
right.
want. The
Yeah, it's
horror
like
stories are real.
Boat setter is the same way. You're gonna buy a really expensive toy to use it, this much of the year.
Oh
Uh,
yeah.
well, let's find a way to make some money with it, and it pays for itself. And as long as you're properly insured,
Right? Yeah,
what
I
could go
actually
wrong?
absolutely. No, I actually know someone who bought a boat and he's like, the best times you've had with a boat is the day you buy it and the day you sell it.
Right.
And so that's where the short-term rental space became really interesting for people because, like you said, it's a lifestyle thing. Like,
Mhm.
this is sexy. Oh,
Mhm.
yeah, I own a vacation rental in North Texas. Oh, over by Malibu? Yeah, I got a short-term rental there. No big deal.
Yeah.
And people were doing well with it,
Yeah.
right? So one of the challenges I had when I was running the numbers is, yeah, I mean, I don't know what you've seen, probably about 30% more per month than what you would get with a traditional rental is what I've kind of noticed. But then you have more expenses, right? Because you have utilities, you have all that. How are the numbers working when you're only putting 10% down?
Yeah. So it definitely got to look at the numbers. And as you and I were talking earlier, for a lot of people, these are lifestyle assets. So
Hmm.
they're not as concerned as, um, on a long-term rental where, it may be more important to cash flow positive. So a lot of my
Mm.
clients were talking to me up front about, hey, if I can at least break even, this thing's going to pay for itself. Someone else is paying for my vacation rental that is appreciable asset. I've taken the accelerated depreciation on. I've got some tax benefits, some tax write-offs from this. So there's some, benefits there. But, you know, the other thing is you can't count on a lower interest rate at this point, but it sure would be icing on the cake potentially if later down the road you got an opportunity to lower your interest rate, lower your payment, increase your cash flow.
Got it. So it used to be more of like, hey, this is my business model. Now it's more of like, hey, we're just kind of offsetting my toy. Oh, like this is
Well,
like the best toy you can buy.
yeah, I mean there's a mixed population
Sure.
where they're going to be more concerned about the numbers. So I would say with my clients, it's about 70/30. 70 is I want to at least break even.
Okay.
30% are I'm making a business out of this. It's all about cash flow. If it doesn't meet these cash on cash expectations, projections, cash flow numbers, I'm not doing it. So, it may take them longer to find a deal, but they're still finding those deals that are working for, the expectations that they have.
And where are they primarily looking? Because like LA, the challenge is they changed the laws in Los Angeles to where
Mhm.
now it has to be your primary residence. You can rent it out for no more than 120 days out of the year. You can get exceptions. There's all these fees. So like LA's basically just said no more. And I've been hearing it across the country. More and more cities are imposing basically they don't want short-term rentals anymore.
Yeah, and most of my clients are looking in more destination vacation spots versus metropolis type areas like LA. So they're looking at, in the Big Bear area or Arizona or, you know, really the best places are where they depend on tourism.
Hmm.
And where they depend on tourism, where it's a big part of their economy, they're also depending on short-term rentals. I think it was somewhere in South Carolina, a coastal area, where the city was considering banning long-term rentals uh, because there was a shortage of short-term rentals, and they were missing the tax revenue off of those that missed opportunity. So
Interesting.
yeah, you're going to see in different areas, based on where they depend on tourism, that those rules would be more friendly towards short-term rentals. But it's definitely, the number one thing that you want to check out when you're looking at an area is, what does the state say? What does the county say? What does the city say? And then what does the HOA say if there's an HOA? So you've got to go through all those levels, because you definitely don't want to be in that situation where you close 2 weeks later, somebody's knocking at your door. What are you doing here? And
Yeah.
so yeah, you definitely have to do your homework, and that's really where a realtor that is not only a local expert but also an expert in short-term rentals can help.
Yeah. And even then, laws can change. Right.
Oh, sure.
So, right, we
Yeah,
have a couple rentals in St. Louis, and we noticed that they were sitting on the market. And then we talked to the property manager who was listing it, and he's like, well, yeah, they just changed all the short-term rental laws in St. Louis. So now all these, what were Airbnbs, are now switching to long-term, and now we have an oversupply.
yeah, and that's a great point. Is not only do you need to find out, what the rules and regulations are for each of those different levels, you also want to find out when was the last time that they dealt with this issue of short-term rentals. And if it was, oh, they've gone forever, the short-term rentals have been operating, they've really never dealt with it, that is a red flag. Now, if you go somewhere and they say, yeah, they allow short-term rentals, but there's all these restrictions that they just put in place a year ago, that may not be a bad idea, because at least they've dealt with it, what the rules are.
How do you find those types of rules? I know every city's different, but like it's not like there's an Airbnb department.
Well, and that's where your realtor can be a resource.
Yeah.
They're either going to know the rules or they can point you in the right direction. But, uh, you know, it typically comes down to the county or the city. So those are typically going to be online where you can find those, or you just call those entities and,
Yeah.
ask to speak to the person that would know what those rules are. And then the HOA is, yeah, just a matter of getting a hold of the deeds and covenants and reading all through all the bylaws. And
It's
yeah,
always so exciting.
yeah. But the places that we have our short-term rentals, they depend on the tourism. They depend on those tax dollars that we pay for our guest stays. So
Yeah. So it's fairly safe in that respect.
yes, yeah,
Yeah.
they have gone through a process, which was great, and really the only change that took place is we have to go through an annual renewal, which is not a big deal. And it's responsible, because part of it is just making sure that we're being a good neighbor, that there's been no complaints, and we always try to be conscious of that. And a lot of our rules for our property that we communicate to the guests are based on us wanting to be good neighbors. So you know, we all have to live together.
And I think that was part of the problem in LA is there was because I would talk to neighbors during my open houses and they're like, yeah, there's an Airbnb the next block over and they're partying on a Tuesday night when the rest of us have to go to work.
Right. Yeah.
And it's like that's not great either. But now you
Yeah.
start to see quiet hours and all of that
Mhm.
kind of stuff. And if there are now Airbnbs where it's designed for events. So if you want to throw that party, this is where you would go.
Yeah, absolutely. And so our one property, our lake house, has a neighbor right beside us, which is their vacation home as well, which is nice. So they're not there all the time, but we still have like a noise monitor on the back deck.
Oh,
Uh,
interesting.
and we let the guests know that the city has an ordinance, and it's lights, not lights out, but noise is to be reduced at 10 p.m. And if there's a complaint, then there's going to be issues. And then our golf course property is in the middle of the fairway on two golf courses, or on a golf course, and no houses all around. And
So party it up.
it, yeah, go knock yourself out. Just don't break anything. It's it,
Right.
and
Simple
that literally,
request.
it's simple request. And of course, cabin is literally groups of guys trips coming in, and yeah, no deal. They're not going to disturb anyone. So go have time.
Nice. Okay, so let's kind of go back to some of these loan programs. So you have the 10% second home,
Hmm.
but in the literal definition, I'm looking at that as this is my second home. It's not designed for an Airbnb. So how is a lender okay with that? Because usually in the loan docs, correct me if I'm wrong, it's all about intent.
Yeah, that's exactly right. And that was part of the changes that Fannie Mae made that I mentioned earlier.
Hmm.
And the literal policy is that your intention is going to be to occupy that property at some point during that first year. So they did
Hmm.
away with amount of days. There's no percent of the year that you actually have to be in the prop. The bottom line is that you can't put yourself in a position where you couldn't occupy the property when you wanted to. So that would be a long-term tenant where you're controlling, obligated for them to stay in the property, and you can knock on the door and tell them, "Hey, I'm going to spend the night." It wouldn't work that way. Now with an Airbnb, a property that is being rented Airbnb, or I should say, marketed on Airbnb and Verbo, if you read in their fine print, they state that they're not facilitating a legal lease agreement. So if you get someone that books the property, you still have control over the ability to occupy it. So you could cancel the booking if you wanted to. Now, I don't advise that because you're probably going to
Right.
get your hand slapped or get kicked off or get suspended. But you never lose control over that ability to occupy the property. And then after the first year of owning the property, you're released from those occupancy requirements. So you could take on a long-term tenant, and that's one of the things I like about the product. And the initial buy-in into the asset class is if you decided, yeah, the short-term rental thing's not working, I am going to take on a long-term tenant. After that first year, there's no problems with that.
Guys, so it's basically as far as Fannie Mae and the loan program is concerned, you just have to be able to have the option to make it a second home. So if you do a long-term tenant, it can't be an option. But if you do Airbnb, VRBO, it's like, well, yeah, there might be a gap for a weekend and I can pop in and stay there.
Yeah, that's exactly right. Yep.
Got it. And are most of your clients doing the 10% down program? Are they doing DSCR loans or is it a mix of everything?
Yeah, so 100% of my business is helping investors buy in this asset class, and 90% of my clients are using the 10% down second home occupancy loan. And, basically that means that the majority of my clients are W-2 wage earners. So it's the, Fannie Mae and Freddie Mac loves that W-2
They
income
do.
as stable. Uh,
All right.
and
You get
and
fired the next day.
Yeah, exactly right. Which, for self-employed people, most people's businesses aren't going to burn down overnight. But yeah, you could have that employer let you go tomorrow a lot easier. But anyway, that's what Fannie and Freddie likes. And then yeah, the rest of what we do typically is going to be the DSCR loan, which is the easiest loan that we do in this space. There are some 10% down opportunities with bank statement loans for second homes.
Mhm.
So if I've got we've got an application that is not product specific, so we can look at everything. And if we see someone's self-employed tax return is not a true reflection of their cash flow because they're writing off what the law allows, then we may look at bank statements to extrapolate a qualified income amount. So, yeah, you can do a second home occupancy loan 10% down with bank statements. So it's not completely off the table just because you're self-employed that you couldn't do a 10% down loan. It's just not going to be the Fannie version.
Yeah, and then for those listening, the challenge that self-employed people have is they have an amazing CPA that says write everything off. So
Sure.
then, yeah, you brought in $1 million, but at the end of the day, you're only showing that you made $100,000 that year. But then on the lending side, you're like, well, crap, we need the opposite. We want you to show that you have $1 million a
Right,
year.
right.
So it's this really tough, clash. So it's like, yeah, that's where the bank statement loans come in, basically, and correct me if I'm wrong, but basically I just say, hey, look, here's my bank statements for the last, what, 12, 24 months, typically.
Yep. Typically, yep.
Yeah, and hey, here's all the income that's coming in. Do you have to source that income?
Um, in what regard?
Well, like for example, if I showed a bank statement, for the last 12 months and I'm seeing $5,000, $2,000, do you want to know where that money's coming from?
No, no. Yeah,
Interesting.
so yeah, we're looking at deposits and deductions. So we're going to go through and pull out those deposits, um, separate any deductions going out, money going out, and then yeah, on the other side, come up with that qualifying amount, which yeah is going to be a whole lot stronger number than what shows up on the tax return.
Sure, sure. Okay, and then let's kind of dive into what's become increasingly popular is the DSCR loan. That's the
Yeah.
debt service coverage ratio. Um, More and more investors that I know are doing it, primarily because the interest rates are finally somewhat in line with investor loans. Because that was always the issue, is it was such a more expensive loan. Can you kind of dive into what that loan product is?
Yeah, so we are not looking at personal income whatsoever. It is all based on the property's ability to show gross income that's going to match the principal, interest, taxes, and insurance payment. So that's going to get you the best terms. We can go negative, but typically you're going to see, a bigger down payment requirement, higher interest rate for a negative cash flow situation. But, this product was originally designed for long-term rentals. So that one-to-one ratio, in the investor world is seen as pretty conservative. And then in the short-term rental world, we're usually blowing that ratio out of the water.
So they'll
So
count potential vacation rental income.
yeah, so there's three sources for that. One is historical data. So that would be it had been operating as a short-term rental previously. The seller's willing to provide financials, which isn't uncommon, that they would have those and provide those because they're an investor themselves. They understand that a
Right.
buyer want to see, performance. So that's one source. Second would be rental comps that the appraiser would pull.
Hmm.
So, they've been doing that forever on investor property loans where they're pulling the rental data on long-term rentals. What we've seen over the past few years in these destination areas is they are getting access to the short-term rental data. So they're coming back with comps for short-term rental. And then our safety net is AirDNA, which is nice because we can look at that data before anyone even makes an offer and let them know the
Hmm.
feasibility on getting an approval before they go through all the hoops and get under contract and start spending money.
Yeah, I like AirDNA. I've used it here and there, and it provides some pretty decent insight, including like, what's the vacancy like?
Yeah, and it's their data has progressed, evolved over time. The information that they provide is evolving and progressing as well.
Yeah.
Yeah, we have a nationwide Air DNA account, and we're able to check that out prior to somebody moving forward. And it's really part of our pre-approval process, because that's the other question is, if you're not approving, or if you're not giving me an approval based on my ability to qualify, how do you issue a pre-approval? So, we're really just verifying credit score, the ability to put down, in most cases, 20%.
Mm-hmm.
We do have some scenarios where you can put down as little as 15% on a
Mm-hmm.
DSCR for experienced investors that have compensating factors. Um, and then, the ability to hold 6 months of reserves for the subject property. But yeah, in this space, it's the easiest loan that we do.
Yeah. Oh yeah, I'd imagine. Yeah, it was when we bought some investment properties last year, we're like, okay, should we look in DSCR? We're like, no, usually the rates are higher, the points are higher. Plus, we had the whole issue of like a lot of them don't allow it to be in a trust. And
Hmm.
then we ended up closing with a conventional loan. And it's like the rate was the same. They
Hmm.
still didn't want us to put it in the trust. It was
Hmm.
like literally like the same. I'm like, this was so much work.
Yeah, yeah. And that's where we've seen the biggest downward movement on rates. So,
Hmm.
we were in the double digits at the beginning of last year on the DSCR loan. And over, a year's period of time, they dropped about 2.5%. So, significant movement, because conventional loan rates haven't done that for sure.
No. Why is it that DSCR rates can fluctuate so much more?
Well, so it just depends on the entity. It depends on the investor. Like, we've been working with the same investor, so that would be the person that's going to buy this loan from us. We've been working with them for a few years. But you have big banks that are DSCR lenders, like the Chases have their product. There's a bunch of big guys are in that space, but then there's hedge funds, there's
Hmm.
uh, different entities, and some of them are borrowing money through traditional means. And so when that Fed fund rate got cut, we saw cuts there. And then a lot of that will drive demand, so supply and demand. So it drives them, the other investors, to be more competitive. So the cheaper the money gets, the more competitive, these entities have to be.
Yeah, so for once, they're actually passing on the savings
Right. Yeah, that's
instead of
exactly
pocketing
right.
the difference.
Well, yeah, and they're being forced to, because others are lowering their rates, and if they don't, then they're not
And they
doing
don't get the
deals.
business.
They want to do
Yeah,
deals.
yeah, because DSCR, they're actually more like business loans, right? Than they really are on the mortgage loans.
Yeah, a lot of people think that they're commercial loans, but
Hmm.
they're loans which, there are DSCR loans in the commercial space that operate
Sure.
very similar, but the DSCR loan, a lot of those investors only want those on residential properties. And, the majority of your lenders in the United States are going to be residential lenders in nature. So that's what's most prevalent. That's what exists the most, or,
Hmm.
residential properties. So they're going to be exclusive for residential properties, but you can do the loan in the name of the LLC. You can hold title in the name of the LLC. Uh, it does require a personal guarantor. So that
Sure.
means, you know, it's your credit being pulled. It's reported on your credit report. When you answer those declarations, are you obligated on, any mortgage notes that don't show up on the credit? Let's say, because I hear that all the time, where companies will claim that reported on your credit, and people think, well, it's not going to count against my debt to income ratio. Well, if you're a guarantor and you're applying for a different conventional loan, and those declarations where it asks you, are you involved in a lawsuit, you had a bank past 7 years, those questions in that is, are you obligated on a mortgage note that doesn't show up on your report, is kind of a summary of that question. But you've got to answer yes, and if you don't, you're committing mortgage fraud. So no go to jail over that.
Yeah, no, no, not worth it. So, do conventional, so I know with oftentimes with a lot of banks, they really kind of cap people out at like 10 loans per customer.
Hmm.
So so I guess there's two parts to it. So DSCR is the workaround to buy more properties. But on the flip side, does that count against your 10 if you wanted to, like say I wanted to buy my new primary residence? Does those DSCR loans count?
Um, yes. But on the
Okay.
flip side, typically, if you've got 10 mortgages in your name,
Hmm.
most DSCR lenders are still going to allow you to do,
Hmm.
3 or 4, just depending on what their policy is. So they
Sure.
don't necessarily care that you have 10 in your name. But yeah, in the case where you want to do a conventional loan on a primary, those DSCRs would be an issue when it came to the ten mortgages in your name.
Yeah. I have clients where like it's a good problem to have, but
Oh, sure.
they're approaching that mark where they're like, okay, that's why a lot of them go into the multifamily space. They're like, I need to maximize each loan that I have.
Yeah. Yeah,
You know,
exactly. Or yeah, they're gonna sell in 1031 and parlay into a multifamily because they've run out of room in the 10. And I mean, that is next level kind of strategy.
hmm.
And we're typically not working with a client on a deal. We're usually building a relationship because they want to build a portfolio. And
Sure.
we work with what I call we work with a lot of what I call first time second home buyers. So they're new
Right.
investors, they're getting started, but they're definitely interested in building portfolios of these types of properties. And yeah, you potentially could use that product 10 times to buy 10 properties if you have that ability. So, when we're talking about scaling and we can originate in all 50 states. We've got the different products, and it's not by accident that I'm aligned that way in this niche. But we're typically going to look at exhausting that 10% down second home occupancy loan, and then we'll look at the DSCR beyond that if they want to scale that
Mm,
fast, because most people's limitation is going to be bumping up against the debt to income ratio ceiling. Um,
sure.
and some people, they are in the mind that, hey, in the next 3 years, I want to buy 6 properties and I want to quit my W-2 job. And it may cause them because of their time frame to get into that DSCR lane, but most people want to stay in the lane where they don't have to put down 10%. So
Hmm.
sometimes that means they have to slow their scaling down
Sure.
so that they can use that income from the property to qualify for the next one, which, if people don't know what that looks like, you only need a year of that income on your tax return as long as it's filed under Schedule E, and then you can use it towards qualifying income on that conventional second home occupancy loan.
Oh, nice. And you mentioned first-time investors, which is actually oftentimes the type of people I work with as
Hmm.
well. Like a lot of like people like, hey, I want to get into it, so I want to start with house hacking or renting by the room. What have you been seeing as some of the hurdles that a lot of these first-time investors are making?
Well, I'm solving one of those problems, which is the capital needed to enter the
Right.
space. So, you know, I get a lot of people that tell me, "Gosh, Jeff, I wish I would have ran into you a long time ago. I would have been able to do something sooner, or if I would have run into you sooner, I wouldn't have had to put down 20%." So, we're solving that cash needed, obstacle challenge there. Um, but you know I think people get overwhelmed, and it's analysis by paralysis, paralysis by
Hmm.
analysis type situation. I see that a lot. But
Yeah.
what I find, and it's question marks, because if you go through my website, one of the questions is what price range are you looking at? And I think I start at like 200,000. I go to, these different $100,000 step ups to a million plus. And one of the choices is it depends on what you tell me I qualify for. And
That's usually what I tell people.
yeah, yeah. And I will say that's probably a good 40% of my clients.
Hmm.
So there's a big segment of the population that they are literally not taking action just because they're not real sure where they stand. So I would say that's one of the biggest challenges is that people just haven't taken that first step just to see where things sit, what they actually do qualify for, because until then, it's just a nice idea that you have.
It was interesting that you bring that up because like one of our goals is to go buy the next one and convert this to a rental. And so I told my wife, I was like, well, why don't we get pre-approved now just to see where we stand?
Yeah,
Or like, hey, this is the price range based off some of the houses we're seeing. So then the lender we're working with was like, okay, then you need to do this, 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 and this to get
right,
there.
right,
Right? But now we have an idea. We also have
right.
an idea of like what our payments are going to be. And it's like, it's what I've noticed over the last couple of years is what you qualify for isn't necessarily what you should be paying, right? Because it's
hmm
based off gross income, not net.
Yeah, yeah. No, that's exactly right. And knowing the numbers is part of it. And what I tell people is my goal for you on the other side of the pre-approval process is to put you in a position to take action.
Right.
And the things that go into that are just the validation, the confirmation, uh, providing the numbers, so payments, cash to close, things in that nature. But you're right, so many people just don't know, and that never is a good feeling. It's not going to put you in a place where you're like, hey, I don't know anything, let's go shop. So like you would never go to the store not knowing that you at least have a credit card in your pocket to cover it, and better yet, you've got cash that you know exactly how much to spend. But you know what that pre-approval allows us to do is just to get the pieces of the puzzle in place, and they don't always fit like
Hmm.
people hope for. And sometimes, like you were saying, hey, if you'll do this, then this piece will fit. So at least and the thing that we gained access to the beginning of last year was the ability to do a soft pull credit.
Hmm.
So that was the other hindrance a lot of people had, or deterrent that people had from moving forward, was don't want my credit pulled. I don't want it to impact my score. I don't want it to go as an inquiry. And so, we'd see people on a pretty regular basis that would say, I'll hold off until I find a, which
Oh gosh.
is a really bad situation,
I used
because
to get
then
that
you're
all the time.
scrambling. Yeah, yeah. And so now, once I tell people on a consultation call, it's just a soft pull. You don't have to worry about it. So many more people that are, moving forward with the next step. So it's nice to have that opportunity for people.
Yeah, I remember, back in the day, people were like, oh, I want to see some properties first. And it's like, okay, but the challenge is we see a property on a Friday, you like it, you can't even start the pre-approval process till Monday. It might be Wednesday by the time
Mhm.
you actually get a pre-approval, and the property could have been sold over the weekend.
Yeah, yeah. And they say, well, I saw a commercial where all I have to do is press a button and I get a mortgage.
I actually have a client that would do that. There's like certain websites where like it's basically a pre-qualification, not a pre-approval, but he's like, because for him, he has real estate investments, he has stock investments. It takes him hours to
Right.
put everything together.
Yeah.
So for him, it's like it's just such a struggle just to then enter escrow and have to resubmit everything again because so much time has passed.
Yeah, yeah. Well, and I equate that to going to the doctor and the doctor
Hmm.
walking in, looking at you and going, "Oh, well, I think you're fine." I mean, you want them to like at least take your blood pressure, your temperature, look in your
Right?
throat, look under the hood a little bit before they say, "Oh, you're fine," and you're walking out going, "Yeah, I'm not real confident in that that process."
It's okay. It's just a flesh wound. It's okay. It's
Right.
okay.
You'll be fine. You'll be
Yeah,
fine.
walk it off. Drink more water.
Yeah,
That's what
that's
they're
right.
telling you. No, in some of my notes I have here, there might be some opportunities for 100% financing, which is always a little scary, right? Because you never want to over leverage yourself.
Right, right.
How do some of those programs work?
Yeah, so I mean, really what 100% financing is, because there's not a product that has zero down payment requirement. So really what you're going to do is you're going to leverage a HELOC against other real estate that you
Oh,
own to
okay.
fund your down payment and closing cost. And I've got a podcast episode that I did on that, creating your own down payment bank. And really what I talk about is not over leveraging yourself. So you definitely don't want a HELOC where you're taking out 100% or up to 100% of your equity, which is nice these days. We learned some things since 2008 where that doesn't really exist. I mean,
Yeah.
there was crazy stuff going on back then, right? 105, 110% LTV. Now these days, it's typically you're forced to keep at least 20%. And my
Hmm.
advice is, don't even get close to that. Don't max out your HELOC for your down payment and closing cost, but it potentially could be a vehicle, and it's a way where you're separating that acquisition debt from your other first mortgage, and then the numbers would show that burden of repayment is going to be on the property that you're acquiring, not your personal income.
Hmm.
So that's what I teach people. That's what I advise people on. Ultimately, people are going to make their own decision, but I would hate to see anybody get in trouble. But some people have a bigger appetite for risk than I do. I have to understand that as well.
Yeah. When we started our investing journey, we used HELOCs. Um, but after I bought my second house hack, we did a HELOC. I had sold one of my rental properties, 1031 exchange, and then my business partner did a HELOC. So we technically bought the property cash.
Okay. Yep.
And so for us, that was the conservative approach because now there's no debt on this property, right? So it's like that offset a lot of this to your point, like we want to reduce the risk because you never know.
Yeah, no, you're exactly right. And, another way that I've seen it done is people will have a HELOC with the available funds to go buy a property with cash.
Hmm.
And so when markets were super competitive, cash buyers were more attractive. You could
Right.
move quicker. You could, acquire property easier, and then you come back with delayed financing. So,
Right.
basically all that means is you're going to put a mortgage in place after the closing. Now, typically, what you need to be prepared for is to leave at least 20% of the deal. So, you
Mm.
may only be able to finance up to 80%. That's going to vary. And then, you may wait 6 months, which is typically the seasoning period before you can get a new appraisal, new value. Maybe the value's gone up, you can go up to 80% of the new value. But the delayed financing, has been a popular strategy as well.
Yeah, I know with one of mine, I did the burr strategy. You buy it, rehab it, rent, refinance, repeat. And we waited about 6 months.
Yeah.
So that way the new appraisal could come in. And I remember because out of our own personal cash, because I'd used from a 1031 exchange, we actually doubled our money. And I just remember at the loan doc signing, my wife's looking at the number. She's like, wait, we just doubled our cash? And I was like, yeah. And like she looked at the payments. I'm like, yeah, and then here are the rents. She's like, unfucking believable. I was like, I'm doing my job,
Yeah, that's awesome. That is
right?
awesome.
And I know that was like a rare case, right? Because in that particular one, the seller was actually super lazy and
Mhm.
wouldn't install hot water heaters. It
Mhm.
needed more work than that, but because of the hot water heaters on a triplex, it didn't qualify for financing.
Oh, wow.
And he had gotten full price offers. He was too lazy. I got it for half off.
Wow.
It was
Well,
180. I think we got it for like 90.
yeah,
I'm like,
and these markets that we're in right now where, things have leveled off and slowed down,
right.
you are seeing, and it helps to be an experienced investor because have experience, you know what has been done in the past. It disappeared for a little bit to an
Then,
extent, a big extent, but now it's coming back a little bit where, have conversations. You just never know what is going to work for them, and you end up getting just this great deal, and it
yeah,
works for you. So, we're seeing more of that, which is nice. Some
yeah.
negotiating, some seller credits, some seller allowances, just different ways that you can keep cash in your pocket.
Yeah, I agree. Are you seeing that with a lot of on the Airbnb side? So it's most, I would imagine it's mostly coming from inspections that they're renegotiating, not so much on the appraisal
Uh,
side.
yeah, not the appraisal side. It's a lot of the upfront negotiations with, on the 10% down loan, you can get up to 6% in seller concessions towards your closing cost.
Hmm.
So that's typically going to cover, the majority of your closing cost. And then, you may be able to use some of that to buy down the interest rate. And then we're also seeing some seller allowances. So if you walk into a place and you identified, gosh, this place needs new flooring, we're going to need to repaint it. You go to them, you've got to get a contractor's bid because
Sure.
the title company can't release money directly to the buyer. But then you go to the seller and tell them, um, we want $15,000 to go towards paint and flooring. We're seeing that as well. But then, yeah, inspection, that's another area where there can be negotiation. And but you're seeing a lot more sellers willing to do some deals where it used to be, "Yeah, I'm not paying for anything. Don't ask for anything. In fact, waive the inspection period, waive the diligence period if you want your deal accepted." So it's nice to see some of the kind of healthy part of real estate investing, come back into play.
I agree. I remember in 2021, people are so excited. I'm like, this has to end at some point.
Yeah.
It's like
Yeah.
it's almost like too dangerous
Yeah.
with how
Absolutely.
stuff, they weren't appraised, like the appraisers couldn't match it, and people were
Mhm.
throwing in money left and right.
Yeah.
I'm like, okay. Granted, they
Yeah.
become new comps. That's always been the argument I've had with people when they're like, well, I don't want to pay over the appraisal. And I'm like, well, the appraiser is just one person's opinion.
Hmm.
But also you become the new comparable going forward. You're basically setting that standard. Rarely have I seen where a home was an outlier. Never
Right.
say never, but it has happened.
Yeah. Well, and what we've seen in the short-term rental space is there's a lot more listings available than we've seen in a long, long time. And that's from people that are in financially challenging situations that they need to get out, they need to sell. But then we're also seeing people that bought during COVID that they thought this was just this passive investment, uh, and it's not. It
Right.
is, it's not like a long-term rental where you lock in a tenant and then you may hear from them a couple of times during the year. You're having, whatever, 20, 30 guests come in and out of the property. So you're managing, you know, correspondence, you're managing cleanings. Um, but yeah, people are finding that this is an active business. So
Very.
that's not what I signed up for. I'm just going to sell this thing. So for the people that, they understand what a short-term rental is, they understand the work that goes into it, the involvement, they're going to see some opportunities right now, even though the interest rates are a little bit higher than where people would like for them to be, because they're pretty average. And
Right.
historically, they're pretty average. They're just higher than they were, back in 2021.
Yeah. With your short-term rentals, how many hours would you say per week you work on it?
Well, so I have a co-host. So I've got someone who helps me manage correspondence and
Hmm.
cleaning. So I'm working with him. I monitor the correspondence. I work with my handyman on the property. So I would say probably 4 hours a week is
Huh,
is what I spend on them.
okay. Which is, yeah, I get like to your point, it's still more than a long-term rental. Like I have the clients that I have that have done that short-term rental, they watch it like daily. Like, oh, there's a random vacancy on a Tuesday. I'm just gonna drop the price to make it like
Right.
dirt cheap. And that's how they've been able to maintain the 98% occupancy rate.
Yeah. Well, and with the growth of short-term rentals has come the growth of these different systems
Hmm.
to automate a lot of the different
Heard
aspects
about
of it.
that.
So you've got, the dynamic pricing tools that, will track what the market is doing from a pricing point and then adjust your pricing based on vacancy and supply. And so some of that's getting pretty good. In fact, our properties are on a dynamic pricing tool, so we don't have to babysit that all the time. But yeah, if you know you're going to monitor that yourself, you're probably going to get better results. But I'm a big believer that some of those machines can make life easier.
And your time is valuable,
Yeah,
right? So yeah, you can monitor it every day, but the hour spent monitoring it, could you have been analyzing more properties, bought another property, and that would have
mhm,
offset the difference,
right, right,
right?
yeah,
That's really what real estate's all about. It's really about time,
hmm,
is what I've noticed over the years. Whether it's the longer you own the property, chances are you'll be fine, or I can keep investing more time into this, or do I automate something so I can go do something else, or hire a
right.
property manager or do whatever.
Yeah, yeah, that's exactly right. And it's, some of those are business decisions, like you said. You could be doing something that is more profitable with your time. So, just things that you have to analyze along the way.
Yeah, for sure. So what do you see the future of lending, right? Because there's all these changes that have been happening over even just the last few years. Now we have a new president, whether we like him or not, that may, kind of encourage certain changes. So what do you see happening going forward?
Yeah, I mean, Trump has always been real estate investor
Hmm.
friendly. And so I think we may see some of the reins loosened on those things that were deterring investors from being in the space, which really was, hey, we're going to charge higher rates and we're going to make this loan more expensive. So we may see
Yes.
some of that go away in the short term. Um, the privatization of Fannie and Freddie, releasing them from conservatorship, I'm not really sure what that's going to bring. Who knows? I really don't know there, but yeah, I just think we'll see the world from investors get a little bit easier to go out there and do things because I mean, really, there's so much of the world or the world, but the United States economy that moves around real estate. Our company or our country really depends on investors, not just the big guys,
Yeah.
making things move because with every transaction, there's money around those. So the economy needs that. They need that movement.
Yeah, I read somewhere it was like there's arguably up to like 60 individual people per real estate transaction.
Hmm.
Whether it's the realtor, inspectors, even underwriters that might be in the Midwest that are handling your loan here in California. Like there are so many people involved in every single transaction. Then after the transaction, you have people buying furniture, you have handyman. There's a lot. That's why it's its own category.
Yeah, yeah, that's exactly right. So, um, I don't know of any studies, numbers that have been done that would show the effect that additional seeing those rate increases had on the economy, but I would have to think that it was fairly significant that there weren't as many investors doing as many deals the past few years.
I tend to agree. And it's really, what I've been seeing is when rates fluctuate so much, it affects the investment world, not as much on the, a residential world, like someone buying their own home,
Hmm.
right? Because that's more of an emotional buy versus investors like, no, the numbers have to work. And guess what? The numbers aren't working.
Right.
And even then that could fluctuate because like here in like LA, when people are like, oh, the rates are going to go up, LA's going to crash. I was like, well, LA has 209 neighborhoods. So you can't afford one neighborhood, you just go to the next neighborhood,
Right. Right.
right? That's 2 minutes away. Like, and that's honestly, that's what we're seeing. I have clients that are doing 40-minute to an hour commute
Right.
and they're totally fine with it. I'm like,
Well,
okay.
and my best example of what that looks like is if you've ever watched International House Hunters on HGTV, and they're in these European countries where, supply and demand is not healthy. Demand is high, supply is low, and they're having those conversations of, yeah, we're going to buy something. Well, if you want to buy it at this price point, you're going to have to move further and further out. But it's not restricting or depressing house values. It's the supply is still there because there's a shortage.
Right. And the cost of construction keeps going up. So even if you could build a new house, why would you?
Right. It's kind of like we'd like to build a swimming pool right now, but the construction costs don't make sense.
How much does it cost out where you are?
To build a nice pool with a hot tub is about 120,000 right now.
Wow.
Yeah.
Okay, so not much different than here, which I've noticed. Cost of construction isn't that much different across the country.
Yeah. Yeah.
I've gotten
It's
bids
expensive.
and yeah, like Nashville to Birmingham, and I'm looking at these prices and like Birmingham, like, isn't Birmingham supposed to be cheaper?
Mm-hmm.
And it's like, no, no, still almost 5 grand to trim a tree. I'm
Yeah.
like, this is I was like, okay, cool.
Yep. Yep. It's
Yeah.
hopefully we'll see some of that level off or improve.
Yeah. Won't it happen in LA anytime soon? Now,
Well,
because
yeah.
we have all the fires. That's why.
Yeah.
So
Yeah.
all the
And
labor, all the materials are going to head that way before they get to us, the rest of
well,
the
and
city.
in the times of COVID, kind of my running joke was is that the handyman now was a high end remodeler,
Right?
because everybody was doing something. So that guy that used to say, I'll fix your toilet, replace your ceiling fan. Now this guy's doing remodels and he's
Yeah.
booked up for, the next year. So yeah, I'm
Yeah.
sure you guys will be challenged with labor for sure.
Yeah. It's always kind of a red flag when a contractor's like, oh, yeah, I'm available to start tomorrow. It's like,
Yeah.
why?
Why?
Why are you available to start tomorrow?
That's exactly right. And it's probably because he burned bridges from wherever he moved from last week. So,
Yeah. Right? Yeah. And contractors are notorious for not being great with money.
right,
And so they need the next job to pay for the last job.
right. That they haven't even finished. Yeah.
Right. Because,
Yep.
and in their defense, I know it's a little bit of a tangent. In their defense, they're fronting a lot of cost,
Mm-hmm.
right? Because we always pay them based on work that's already completed,
Yeah.
which is
Yeah.
always kind of
But
the challenge.
then the mismanagement comes into play, and yeah, they can't finish one and start the other. And yeah,
Yeah.
it's common, but that's why it's good to check out your contractor.
And you have to become a project manager whether you like it or not.
Yeah, that's exactly right. That's
Yeah.
exactly right.
All right. Well, was there anything else that you wanted to touch on
No,
before?
you did a good job of answering questions around just the basics, the main product that we use, the DSCR loan, which is secondary. And yeah, it was very comprehensive. There's a lot of good information on my podcast as far as kind of next level strategies and things that, are nuances that maybe people haven't come across before. So those are all micro podcasts, 10 minutes or less. And it's really,
Oh,
hey,
that's great.
here's this subject, here's this information, boom, here, let's, move on to the next one. So good topics there for people that might be interested.
Very nice. All right, Jeff. Well, thank you for being on the show. I really appreciate it. How can people get a hold of you?
The best way to connect with me is through my website, purehomefinancing.com. And it's all designed to educate people on the products that we use, the process, and then, I want to talk to everyone to proceed with the pre-approval process. So those videos were designed out of the necessity to have hour and a half phone calls just regurgitating information. So now, people can look at those videos instead of, listening to me on a phone call. And so then when we do want to get on a call, it's more of, here's a couple of questions that I had, and then here's my dream. And then we can talk about next steps. But yeah, just having a lot of fun talking to really great people doing great things in great places. So yeah, it's as a lender, life doesn't get any better.
Very cool. Well, thank you so much for being on the show. And thank you everyone for watching or listening. And maybe we'll talk soon. Maybe we'll talk in a few months, maybe next year, and see how things have changed.
No, that sounds great. Thanks for having me.
Cool. All right. Thanks so much. Thanks for tuning in to The Key to the City of Angels. I hope you found today's episode helpful as you navigate the world of Los Angeles real estate. Whether you're looking to buy your first home, expand your investment portfolio, or sell in this competitive market, I'm here to help you succeed. Let's connect. Visit my website or follow me on social media to learn more about how I can help you achieve your real estate goals. And if you're ready to take the next step, don't hesitate to reach out. I'd love to work with you. If you've enjoyed this episode, be sure to subscribe, leave a review, and share it with someone who might benefit. Together, let's unlock your potential and make your real estate dreams a reality.